Welcome to Research Recap on JP Morgan's Making Sense. I am Lauren Brice, and I'm joined by Mike Feroli, our chief US economist, and we are here to talk about takeaways from the January US employment report, as well as the path ahead for the economy and for the Fed. Mike, thanks so much for joining.
Thanks for having me.
So lots to talk about in today's print. What were your high-level takeaways?
Okay, big picture. I think it's actually more of the same, and the same is a good thing. So the headline was 143,000 jobs, which was, just a tiny bit below expectations, but nothing worth getting excited about. It's actually pretty close to the average now, what we saw over the last year. The unemployment rate moved down to 4%. So that's a, good, solid, tight labor market. We did have an upside surprise in average hourly earnings, a downside surprise on the work week. Those may have been weather distorted, but the big picture we think is a job market that looks pretty solid, still producing good job gains, good labor income growth, is tight, but probably not too tight. So it's a pretty favorable picture overall.
And this report included revisions to the establishment survey and the population controls in the household survey.
Right.
What were your key takeaways there in terms of the revisions when thinking about the overall trend of labor growth?
So it definitely added a lot of noise to the report. I would say on the establishment survey, and this is, non-farm employment, the level was revised lower last March and last December by roughly 600,000. That wasn't really a surprise. BLS had already kind of previewed that. It does take, the average job growth last year down a little bit. The revision to the household survey, also not a huge surprise, but added a lot of confusing aspects to how you read the report. So the overall population estimate for the beginning of the year was revised up almost 3 million to account mostly for higher immigration, which also raised the level of employment in the household survey by 2 million. And it did distort a little bit how we look at the month-to-month decline movements in the unemployment rate. So as I mentioned earlier, the unemployment rate moved down 1/10 to 4%. When you account for these population estimates, it may have actually moved down 2/10 between December and January. Again, that may be a little too much in the weeds, but that was some of the implications of these revisions here.
Thanks, Mike. That's helpful. And you mentioned, noise related to weather conditions.
Mhm.
I guess, is there anything in the numbers today that suggest your forecasts, were too large or too little, or anything that we should kind of take away in terms of the look ahead?
Yeah, so we don't think either the fires or probably more importantly, the unusually unseasonable weather had a big effect on the employment numbers, but we do think it could have distorted the earnings and the work week numbers. So as I mentioned, the work week declined, average hourly earnings were a bit stronger than expected. You often see this in bad weather weeks and months because if people, can't get to their jobs, their average work week is going to go down. But if they're a salaried worker, then their average hourly earnings goes up. So we would expect this to perhaps reverse itself in the February report, provided that, the weather next week, which is the February survey week, isn't as unseasonably poor as it was in January.
And then I guess looking ahead from here, we have the new administration, and although large-scale deportations aren't our base case, there's certainly a risk to the forecast. How are you thinking about the broader impact of lower jobs growth, labor supply shortages, employment costs, and then ultimately how that feeds into growth?
Yeah. So I think it's safe to say that, looking ahead this year, we should see labor supply growth slow just because you're going to have fewer crossings, border crossings. And so, the average pace of job growth, which was last year close to 170,000, may step down, closer to 100,000 this year, I think would be, a reasonable guess. We don't have right now factored in big numbers for deportations. That is clearly a risk. We tend to think we need to see more federal resources appropriated before that really kind of starts to materialize. I do think, certainly there's already been some talk that perhaps as soon as the February jobs report, you could see employers be a little more cautious in who they hire because of documentation concerns. So that is something I think as we approach the next jobs report, we'll probably have a lot more market chatter about. But right now, it's hard to know for sure how that's going to play out.
And then I guess, in a similar vein, top of everybody's mind this week is the fluid story of tariff policy and timing of implementation.
Right.
Can you talk us through how you're thinking about the latest developments and then I guess the impact on sentiment and inflation expectations, which we know the Fed is paying very close attention to?
Yeah, right. So in terms of what actually happened this week, it's not nothing, right? 10% on Chinese imports. It's our third largest trading partner. There were some changes in implementation relative to 2018-19 that also may give those tariffs a little more bite. That said, I think, we market participants and businesses have probably been expecting that China would be in the crosshairs when it comes to trade policy. So this, by our estimate, could boost overall, PCE inflation by maybe a tenth, and it could have some effect on sentiment. Sentiment gets a little trickier to think about because not only is there sentiment surrounding China, but also now the uncertainty around NAFTA or USMCA trading arrangements. So that alone could have an effect that starts to weigh on capital spending as we look out into the second half of the year. And then, as you mentioned, inflation expectations, right? So we did see also this morning in the University of Michigan survey of consumers, a big jump in 1 year ahead inflation expectations. And it seems like some of that probably is related to tariff concerns because it's kind of hard to explain it with actual realized inflation developments over the last month. So I do think that creates, a bit of a dilemma for the Fed because, you have some downside growth risks from this uncertainty. You also have some upside concerns on inflation from the tariff story.
Great. And then I guess lastly, and keeping on the topic of inflation, we had the Fed meeting last week where in the statement they, said they were happy to hold rates here in restrictive territory until we see more progress on the inflation front. I guess what parameters are you thinking about both on the employment and the inflation side that may spur some sort of action around a move in the cash rate?
So right now, as you say, I think the Fed is very comfortable just, being on hold here for quite some time. On the side of what could spur them to rate hikes, I think in addition to these concerns about inflation expectations, realize inflation, and then I think they would also need to feel like the labor market is tightening up again. We saw a little bit of that today, but I think they would need further evidence to kind of switch to a more balanced bias. And then I would say on the downside, if you do start to see any deterioration in business sentiment, in business hiring, again, perhaps related to immigration, perhaps related to trade, then they would be poised, I think, to cut rates. But right now, as I said, I think they're very content to stay out of the spotlight and just be on hold for as long as the data allow them to.
That feels like a good place to close, having discussed the landscape for the labor market, growth, the Fed, and inflation as we look ahead throughout 2025. Mike, thank you so much for joining and for sharing your thoughts. And I'm looking forward to chatting again with you next month.
Thanks for having me.
And to our listeners, be sure to stay tuned to Making Sense next Tuesday as Patrick Whelan, head of FIC Digital Markets, and Gagana Fiel, global co-head of macro sales, delve into the latest findings from our 9th annual e-trading survey. Here's a sneak peek from their upcoming conversation.
Once again, and it was 100% of respondents saying that they expect e-trading to grow in 2025. It's a large number of participants to all say the same thing. It was the only part of the survey that we had 100% agreement on. It was also interesting that they were pointing to EM rates and credit as being two of the areas that will continue to grow in terms of electronification in 2025.
That full episode will be available on Tuesday, February 11th. Subscribe to Making Sense so you don't miss it. Thanks for tuning in.
Thanks for listening to Research Recap. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, and YouTube. This communication is provided for information purposes only. For more information, including important disclosures, please visit www.jpmorgan.com/research/disclosures. Copyright 2025 JP Morgan Chase & Company. All rights reserved.